So here's the whole strategy that I used in eToro. I'm not trying to predict the market every day. Most of the time, I run a calm, diversified ETF portfolio, and only when the market is in full panic mode, I switch into a small basket of undervalued, high-quality stocks that are built for rebounds. If you only do ETFs, you can miss some of the biggest rebound opportunities. If you only do aggressive stocks, you can get wrecked in normal times. So the combo is stable foundation most months and a turbo button during rare market crashes based on clear signals, not emotions. The foundation is a tactical asset allocation style portfolio rotating across 4 ETFs that don't all move the same way: US stocks, international stocks, real estate, and commodities. The whole idea is simple: diversify across different engines so you're not relying on one market doing well. The rule is monthly. At the end of each month, I check momentum for each ETF. Then the portfolio stays invested in this diversified ETF mix. And if the market environment turns risk off, there's a safety protocol. Shift to a safe haven asset like IEF. So the goal becomes capital protection instead of force the gains. Performance-wise, this part is meant to be the stable engine. Around 14% annualized, and the results shown: max drawdown around minus 10.7% and a Sharpe ratio of 1.86. So pretty efficient for a foundation-style strategy. Now for the fun part, the accelerator. This is not running all the time. It's designed for the moments when the market is basically freaking out and prices get irrational. This activates when panic is extreme. The trigger is either the S&P 500 price to book drops below 2.2 or the VIX spikes above 30. Basically, I want objective people are scared signals, not just headlines. Then I pick a small basket, about 5 to 10 stocks. The screen is straightforward. Strong business quality like ROE above 15%, cheap valuation like P/E under 15, and momentum confirmation with positive relative strength. It's aggressive on purpose because this is meant for rebounds. When the signal hits, the portfolio rotates fully from the ETF strategy into this concentrated rebound basket. And when things normalize or momentum fades, I switch back to the safety of the tactical ETF portfolio. So the risk-on period is purposeful and time-limited. In 2020, the crisis year, this approach shows a plus 64.1% return during that rebound window. That's the exact kind of environment this part is built for. Now, when you combine the calm foundation with the crisis accelerator, the compounding is the story. In the results shown, 100,000 grows to about 1.24 million over 10 years. Total return plus 1,163.8%. The S&P over that same period is plus 200.6%. CAGR comes out around 28.6%, and it's about 4.3 times the benchmark outcome. What I like most here is consistency. Even in rough years like 2018 and 2022, when the S&P was negative, the combined strategy stayed positive in the example shown. And yes, 2020 is the standout because the crisis switch is doing what it's supposed to do. Let's talk risk, because returns are nice, but drawdowns are what make people quit. During the March 2020 mess, the S&P dropped about 24.9%. The tactical ETF part was around minus 8.3%, and the combined strategy shows around minus 6.6%. That's a huge difference psychologically because you're far less likely to panic sell. Risk-adjusted numbers are strong here. Sharpe of 2.90, Sortino 7.67, volatility around 9.2%, and the monthly win rate is about 80%, 96 positive months out of 120. Basically, it aims to keep the ride smoother while still compounding hard. If you remember one thing, it's this: ETFs by default, RPR only during panic, and then back to ETFs when things calm down. The whole edge is the switching discipline, doing it because the signal says so, not because the news feels scary. Quick reminder: past performance isn't a promise, and investing always has risk. This is just the framework and the rules from the strategy.